You can see that we are looking at the second quarter of 2023. And when you look at the balance sheet, it's broken down into two major groups. You got the asset section on the top, and then you have the liability section. Okay. And then the difference between those two is the equity, which you are going to see right here. So when you take the total assets, which is this number right here, which is the 46 billion, I'm sorry, 463 billion, and that number is in billions. That's $463 billion in assets, and you subtract your total liability, which is $307 billion. When you subtract those two numbers, you get the total equity, which is 155 billion. Okay. So how they are calculating the debt to equity ratio is they're coming onto this balance sheet and they're coming into the liability section, which is right here. You got your liability section and they are looking for anything right here that has a word debt. So right here we can see that has a debt and the number therefore is 45 billion. Then you come over here and you have another thing that says debt. Okay, so that 45 billion that you take that, and then you are going to add this total long term debt of 219 billion. Okay, and you are going to add up those two terms that have debt attached to them in the description there. When you add up those terms, which is in case is going to be that 45 billion plus 219 billion, you add those two numbers up and then you are going to divide that number by the total equity. That's you got 45 million plus 219 billion, and that's going to give you 264 billion divided by equity, which is 155 billion. That's going to give you 1.7 ratio. Now there are other ways you can look at the debt to equity ratio. Some people like to come in and they would like to use the total liability. They would actually like to compare all of the liabilities and here compared to the equity. And in this case, you would see it's almost uh, you got like 307 billion, the total liability, divided by equity, which is total equity, which is 158 billion. The ratio comes around 1.98. And that's a little bit of a higher estimate. And if you're a more conservative investor, that might be the approach that you might want to take instead of just taking the debt terms inside of the current liabilities and the total liabilities. So just some different techniques, and that's totally up to you how you want to assess your valuation. And I recommend you obviously a more conservative approach is your in the beginning, and as you get a little bit more comfortable, maybe you can ease up on how conservative you are on your approach. So for Brookfield Corporation, we saw that the debt to equity ratio was 1.7, which can generally say is a pretty amount of debt. The easiest ways to understand this is for every 1.7 dollar of debt, there is $1 of equity in the business. So let's go ahead and look at another company called Disney, Walt Disney Company. The ticker symbol is DIS. To do that, we are just going to go up to the top. We are going to type in DIS ticker symbol, which is the ticker symbol for Disney, and we go ahead and look at second quarter of 2023 under balance sheet, under financials. So here you see the total asset is 203 billions, and you subtract total liabilities, which is $92 billion. When you subtract those two numbers, you get the total equity of $110 billion. So the debt to equity ratio, so debt is equal to current debt, which is $2.6 billion, and the long term debt is $44 billion. So totally, which is $47 billion. So debt to equity ratio is uh, total debt, which is $47 billion, divided by the equity, which is $110 billion. The ratio comes down to 0.425. And that number is good. And the easiest way to really understand the ratio is for every 50 cents of debt the Disney company has, there is a $1 of equity in the company. which is really good. So that's the first tool that we have to assess whether we have vigilant leaders leading the company. Go back and check out our next tool, which is the current ratio. Like before, we are going to go ahead and use Brookfield Corporation Company and the Disney Company to assess the current ratio. So what is the current ratio? It gives us an idea how will the company handle debt in the next 12 months. So when we are looking at the debt to equity ratio in the last scenario, that was just a general overview of all the debt added up, and then we are comparing it to the equity that the company has. But in this scenario, we are going to look at how much money the company expects to have coming in the next 12 months and how much they are going to have to pay out in the next 12 months. When you look at that comparison, we can then determine how much debt potentially is this company going to have to take on if they have to take on any debt at all. So when we look at the current ratio, Charlie Munger likes the current ratio above or greater than 1.5. So that's important. You're going to want to write it down. 1.5 and above is what you're really looking for in a current ratio. So let's go ahead and pull up the companies from the Yahoo Finance. So here we are back at Yahoo Finance with Brookfield Corporation at the top level page. Just follow the same technique as we used before. You type in BN, Brookfield Corporation, ticker symbol is BN, is up here in order to get the Brookfield Corporation company. And we are going to go back to the balance sheet again in order to determine the current ratio. When we look at the balance sheet, we have the assets broken down into two sections. At the top, you have the total current assets, and then you have just total assets. When a company lists something in the total current assets, this means that the company will likely convert whatever that is the number into cash during the next 12 months. So this $57 billion in total current assets that's going to be converted to cash in the next 12 months. That's going to be a positive. That's what going to flow into the company. Similarly, when you go down into the liabilities, it's broken down into two sections, total liability and the current liability. So current liability is what they are going to pay out of the company in the next 12 months. And that is $60 billion, which is greater than the $57 billion that they have flowing into the company. So when we talk about the current ratio, all we are doing is we are taking this top number, which is the money flowing in, and we are dividing it by the money flowing out in the short term 12 months. So if this was 60 billion and this was 60 billion, our current ratio would be 1.0, meaning all the money flowing in is exactly same as the money that's flowing out of the company. So you're not going to see a change in your equity in the next 12 months. So in this case, if you want to figure out the current ratio, we take 57 billion divided by our 60 billion, we get 0.95. And if you remember, I said Charlie Munger likes to buy companies that have a current ratio above 1.5. So in this case, Brookfield Corporation current ratio is 0.95. We want to see a positive number above 1. So let's go ahead and look at the company Disney. So we are just going to go top here. We are going to type in ticker symbol DIS and hit enter. We are going to go to the financial section and we are going to go ahead and click on the balance sheet and make sure that you are on quarterly. When you look at this number, we see that the number is just 30 billion current asset, which is going to flow into company, and the current liability, which is 28 billion, which is going to flow out of the company. So when we take the top number divided by the bottom number, we get a current ratio of 1.07. We'll just say 1.1, and that is not bad. There is something that you would want to look because that's above 1.0. Based off of that, they are going to have to take on more income in next 12 months. So when we are looking at this current ratio, it really tells us a lot about the financial health of this company as we look into the short term in the next 12 months. And for Disney, it's pretty good. It's at 1.1. That is something that we want to look at. I strongly encourage you to go back and do a little bit more research on your own with the debt to equity ratio and also the current ratio. Those are your two tools to understand how much debt a company has and whether it's manageable or non-manageable. And this all falls under the first rule of Charlie Munger and great investors like Warren Buffett and Mohnish Pabrai. And that is, a stock must be managed by vigilant leaders. So use those two tools to your advantage and don't settle for a company that has a lot of debt. So this concludes our day 19 where we talked about Charlie Munger's first rule, we talked about vigilant leadership, the debt to equity ratio, and the current ratio. See you in the next.